Hey everybody, Raghee here. Welcome to just a little experimental broadcast that I'm doing here. And that is, we've got non-farm payroll today. And if nothing else, if you catch this on replay and you're wondering, all right, Rog, how do I deal with these hot zones? I thought I'd come on live and we'd have just a brief discussion. And if there are other economic events that would make sense for us to do this, in the future, we'll add this to our regular charts and coffee routine. So it's 8:25 a.m. Eastern. It is 5 minutes in front of the non-farm payroll release. Why do we care about jobs, whether that be initial claims every Thursday, whether that be non-farm payroll the first Friday of each month, or even the JOLTS data that we got this week? Why do we care about jobs? Let's talk about this from a macroeconomic standpoint. All right. Now, I emphasize macroeconomic because there are very specific pillars of macroeconomic pillars and macroeconomic data, meaning what is going to help the Federal Reserve, one, make a decision and justify their decision to the trading and investing public. So they're going to always lean on the data. Which data? It's not all of it, right? All of it is not important. It's primarily growth, inflation, and jobs because the US central bank has what's known as a dual mandate. In other words, they're trying their best, for whatever that's worth, to maintain a certain inflation rate and a certain employment rate. So they have a dual mandate. They have two focuses, right? Is two foci? It should be. It should be. So let's talk about the way in which I prepare for NFP, this particular hot zone. So hot zones are what? They're scheduled economic releases, right? Where we know there's going to be high impact, high volatility. And so I'm going to be measuring this two ways. One, there are certain data points that help us understand what expectations may be. So I'm going to grab the handy dandy little makeshift whiteboard here. There we go. And there's some private data. So I'm going to put my notebook away here. All right. So there's some private data that we'll see in play. And I'm going to type this along the top here. Challenger. So there's Challenger job cuts. There are the ongoing initial claims, right? We have also continuing claims. So there's initial claims and there's continuing claims. Now, this is all publicly accessible data. And remember, you're always looking at this on a rate of change. In other words, what is the trend? Is it trending higher? Is it trending lower? Those three items, along with, well, we had a pretty flat reaction to the ADP, right? Payrolls. We also want to take a look at things like consumer confidence, which we saw recently. There's two ways you can look at consumer confidence: the CB board or the University of Michigan. I don't really pay attention to the University of Michigan, but really any consumer confident number, these confidence numbers, there's multiple. So you can keep an eye on those. What's the consumer thinking and feeling? That's very much going to map to their employment situation. And then we can also look at employment numbers, right? So mostly manufacturing, but manufacturing and service ISMs, right? The ISM data. Now, this might seem like a lot of alphabet soup, right? But that's what macroeconomic rate of change is. Do you need to know what all these are? You really don't. Although with Google, you can get a quick idea of what they actually mean. And then look at the trend. Look at the data, the trend immediately in front of non-farm payroll. That's just basically how you can do it. It's not super difficult. And you might say, well, Ron, that's a lot. Not really. When you think of just a sea of data that's out there, there are certain economic releases that sort of map to what we could expect. Now, is this about my guessing? This number is going to come out in just a few seconds. Is this about me guessing which way the markets are going to go? Not at all. So on this chart, I have the daily on the right, and I've got a larger 5-minute chart on the left, right? So what I'm looking at is time in volatility. This data is factoring in 6 months of Fridays, which is going to also include 6 non-farm payroll Fridays. So this is not average true range. Remember, average true range has no clue what happened the previous Friday, really. Depending on the length of the average true range, it's got no historical understanding. It's a much more immediate look at volatility, which has its value, but it's lousy at historical volatility, right? And by the way, the other thing applies too. If volatility adjusts very quickly, historical lookbacks really aren't going to be helpful. I choose the historical lookbacks. It's usually going to be the most helpful in terms of understanding volatility. The idea that we can look at what typically happens on a Friday between 8 and 9 a.m., which is what you see on my chart here. And the idea that I also know, let me grab my drawing tools here. And for those of you that are catching this for the first time, you'll see there's a process, and I'm happy to answer some questions. Feel free to type them in. Let's just get through the first few minutes of this. So I've got a line in the sand, right? Line in the sand right there. That's a level where there's a lot of psychology going, there's a possibility for momentum through it. There's a big possibility of resistance at it. Now, I don't know where prices are going to go, right? All we know is usually what happens. And I really wanted to do this because I wanted to take something that was crazy volatile, really high impact, something that's very hard. It's a wild card sometimes, and say that our likelihood, because this could have gone very differently, but our likelihood of looking at resistance up in this area and support in here, our understanding of this being the range can be identified with historical volatility. And that's really what I wanted to show a lot of here, because we can better brace ourselves for an understanding of what could happen. Remember, gang, we don't know what's going to happen. This is not about prediction. Trading is all about process. It's process over prediction. And I'm having some kind of hair day today. You know, my hair and makeup team that prepare me for charts and coffee were clearly not available for my non-farm payroll broadcast. So there's your historical volatility look on the S&P. All right. So look how we're sandwiched. We're stuck in that area. Now, you're watching this 5 minutes before we started. You saw that level, that zone was there. Remember this, non-farm payroll takes about 12 minutes, I've found on average, after watching quite literally dozens upon dozens of these for decades. It takes about 12 minutes for all of the data to be understood and then reacted to. We get a headline number. There's 2 headline numbers we'll get. I want you to notice something so far, gang. It's 8:33 a.m. I don't even know what the number is. I don't actually care. Not yet, right? So don't think that playing hot zones, scheduled, high impact, high volatility, economic data releases is about knowing what the number was. You will get there eventually, but it's really about the reaction, right? I don't want to say this is what I think. We want to counterpunch. We want to understand. So you might say, okay, Rag, I get it. I get the hot zones that you're looking at to get an idea what the number might be. I get that you're looking at historical volatility, resistance and support. It's done a very good job so far identifying where the market could go. But now what, right? So this is about 4 minutes in. We're 4 minutes in. The market's had a chance to look at the average hourly wages. Let's go back to, and I just use a site called Forex Factory. I've been using this site for about 20 years now. It's just a great global economic calendar. So now I can go ahead and notice, I don't even know what the numbers are. I'm being quite literal about don't know and don't care yet. But 4 or 5 minutes in, I'll go take a look. Numbers 390,000, slightly better than expected. Then we had an upward revision in the previous number from 428,000 to 436. By the way, when we hear these numbers, I know in my mind it's as if I'm listening to Charlie Brown's teacher. Wonk, wonk, wonk. What does that help us with? Do I really want to buy that number? Does that mean it's a buy? Does that mean it's a sell? Realize we don't know, because there's also other data within this massive non-farm payroll report. Average hourly earnings are down. That's not good. Employment rate, it's 3.6. Again, not good. So how do you take a look at those three major ideas and then start to say, well, do I buy this or whether I sell this? Okay. There's a couple things to remember. The market expects 325, but there are also whisper numbers out there. And maybe we'll get to this another time in the rooms, but there are whisper numbers out there that suggest, hey, there are other numbers, there are other factors, there are other expectations that are already also priced in. We know this with earnings. There's company guidance, there's the estimates from Wall Street, and then there's the whisper number. Data releases have that too, right? Data releases have that too. So rather than my guessing at whether or not that's bullish or bearish, because frankly, I don't know. Take a look at what's happening in price action. Guess who else doesn't know what to do with this? The markets. They don't, is this good? Is this bad? We don't know. And you can see both sides duking it out. And notice again, that volatility is sandwiched by this range. So you might say, okay, Rob, what do I do with this? All right, let's get to that part. And then we'll definitely tackle some questions. That's resistance. That's support. We should presume exhaustion at both levels, right? Until we either break above or break below, neither which has happened. We should also look at the psychology that we inherited. What was the psychology going into NFP? How did traders and investors and whomever, right? Skynet, algos, whatever, how did they pre-position in front of non-farm payroll? Bearishly. They sold into this number. What was happening is bearishness, selling, downward pressure. So I'm going to presume there is bearish, right? Bearish directional bias. A little bit of bearish directional bias that preceded the 830 hot zone. So it's almost as if we're flying down the highway and we let off the gas. Does that mean we turn around and go the other way? No, that just means we're slowing down in the direction that we were heading. So keep in mind that ultimately, when we're looking at something like this, look at what was happening before the release, right? Immediately before the release. And again, it's a 5-minute time frame. Then look at also the volatility. What's the range we're likely to move in? Okay. Now, I would rather find a short sell. I would prefer to have the short side of this market. This is how we pick a side. I really don't want to go into an event without directional bias, right? I don't really want to make a decision without having decided, is there a direction of higher probability or not? So this is what we inherited. Let me, that's a lot. There we go. I don't need 5 days. I just need a little bit of action from this morning. All right. So that's the psychology we inherited. By the way, another thing to note, we're still below, right? That's a huge line in the sand right there. You can see it right here as well. Big line in the sand. So most of the position I have on and what I'm doing, and I hope, you can see the contrast between, I can make some guesstimates about data. And by the way, if you go back and look at Challenger initial claims, the rate of change, the ADP, consumer confidence, both, there's two kinds, the Consumer Board and also University of Michigan. And then the ISM numbers, there was a slight bearish edge, right? There's a slight bearish edge. And again, this is not, gang, you don't have to be an economist to do this stuff. I know television and all those folks want you to think you can't do this. Gang, I'm an English major. This wasn't what I studied in college. This is studying human behavior. This is studying psychology, almost sociology. What were the data points specific to what would map to an employment picture? And how do I pick a direction? And you might say, Rog, I don't get that whole macro thing. Don't worry about it. You notice that a lot of my decisions were made on what did we get, what were we looking at before the release? So I was already bearish. Look at all this red, right? traded up into the resistance zone. You watch this live. That zone was sitting there before NFP even came out. That zone was established as the 8 o'clock hour was putting in its highs and lows. That's how you study time and volatility. We get up to that resistance level and I short it. That's it. I don't put on big positions with NFP. I would say most traders would do far better looking at micros and small positions. Gang, non-farm payroll is unbelievably risky. Volatility can be brutal. This is not for new traders. This is not for new day traders. This is not for low risk tolerant day traders. And if anything else, maybe watch this from a standpoint of just understanding the psychology, right? Maybe you watch this and say, okay, Rog, I'm just going to watch the psychology just so I have a better understanding of how these things are digested, right? Notice we did not even look at the numbers, average hourly wages, the unemployment rate, or even the NFP number itself until what, 4 minutes? I wanted to document this with you all. And I thought, Rog, I was talking to the Lorna bot. Those of you that are in the room know, I was talking to Lorna bot, said, I want to do this little experiment. We'll do this live. I want to show folks how the volatility levels work. And I want to document it live, not after the fact. So this could have been great, or it just could have been a crushing defeat. But I want, and that would have been very, very helpful too, to see how does a trader, a seasoned trader, handle a market moving against them very quickly. Heck, that might have been a better lesson. But it's kind of fun to sit in a group live and say, hey, we've got a resistance level. We inherited a weak market. We already had, based on the handful of specific data that maps to NonFarm Payroll, a little bit more of a bearish expectation to the result. We know it's going to take about 12 minutes. Gang, it's 8:42. Do you see how right about now we're starting to pick a direction? It takes a good bit of time. Remember I said wait 12 minutes to see that broader direction? I don't know why 12 minutes works, but when you watch dozens on dozens and dozens of these hot zones, certain patterns emerge. It takes a little while for the total, just the monstrous amount of data in this report to be digested. You're not going to know in the first wick. In fact, for Momo traders getting caught up in this first wick, unless they were quick, unless they knew where that volatility support was, unless they were quick, it didn't end well, did it? Now, if they knew where the volatility was and said, hey, I'll buy 41.45 to 41.40 and get out around 41.60 to 41.55, that area where we were at the time, great. They had a nice little 10, 15 point trade, maybe 20 at best, and they got out. But the rest of us, the way I walked you through it, bearish, rate of change on the data points, bearish, get up into the resistance. That is our edge. And then 12 minutes in is the follow through a little bit more visible. Okay. And all the while we were south of that line in the sand. So I hope that those pointers help you understand a little bit more about, how I'll look at non-farm payroll. And frankly, I'll do the same thing with initial claims. We can do similar things with GDP. These 8:30 hot zones are kind of neat. Now, for those of you saying, Rog, this is fascinating, but I don't trade futures, there's an interesting phenomena that will happen fast forward 9:30. Now, this is just Forex traders and futures traders and those kinds of markets that we have, we are able to react to this too. At 9:30, we kind of get this echo effect. In other words, the folks who come in at 9:30 when the equity markets open, and now they have a chance to react to what happened, an hour earlier, it will oftentimes echo what happened at 8:30. So there's that echoing kind of going forward effect. And I'll expect something similar. Even if we wander up higher and we have a little bit more strength into 9:30, even if we don't, I'll look for some weakness, as stock traders can look at what futures traders did and what the markets did pre-market, right? And they'll say, oh, this was bad, this was negative, and we might have not a huge bearish response, but we could have a rather some rather bearish momentum on the bell, right? And that's really it, gang. So I thought I'd spend about 20 minutes with you all walking it through. It took us about 5 minutes to prepare. I showed you what I look at. And this is just, gang, this is high volatility, high risk. Take your Dramamine, buckle your seatbelt, put your helmet on kind of trading. But I thought, what better way to show you all in front of NFP? Now, notice now with the volatility that we're seeing, the ranges are starting to narrow. The trade's already done. I need these levels to be set before 8:30, right? So that's why I wanted to do this live with you all, so you could see how the volatility levels were positioned before the volatility. And then after, as we get this increase in volatility, they're starting to react. By the way, here's another great thing that these tools do. And I love this about this tool. As things get more and more volatile, it's almost like the HPMRs are closing a window and saying, stop, just stop now. The opportunity, the best opportunity is behind us. Those HPMRs literally coming together and closing a window is almost a visual reminder to say, don't jump in now. Don't try to overtrade. Don't see the move that happened before and say, yeah, I want a piece of that now. The main part of the psychology is done. So I hope that makes sense. All right, by the way, we will still have our 9 a.m. to 9:20 charts and coffee. And I just wanted to make sure we had a quick recording for this. So let me grab a few questions and then we'll call it a wrap. And then I'll see you all at the top of the hour for our next show. Let's see here. What does NFP mean for smart money? Anders, I don't know who smart money is. Yeah, I don't know what that means. Can you break down the chess match? I don't think there's such a thing as smart money, my friend. There's big money. There's big money. But I understand what you're saying. But the chess match question is awesome. So what does this mean? All right. We go down the rabbit hole anytime that we're in a monetary policy shifting environment. So a stronger than expected job number, gang, generally speaking, that should be, this is where good news, good is bad. If the jobs picture is looking pretty healthy, why would the Federal Reserve, why would we sell off on a good number, on a strong number? Because this green lights the Federal Reserve to go on with their path. Remember, yesterday, I believe it was Meester who said that we don't see any reason to pause in September. Half-point hike in June, a half-point hike in July, and probably another quarter, maybe a half in September. Is there any reason for the Federal Reserve to tap the brakes with a strong jobs picture? Remember, we have a dual mandate in the U.S. that the FOMC, the Federal Reserve, has. They have two jobs, two focuses. So here, I would look at that chess match question. Cool angle, great question. It should generally be perceived as bearish because green lights more hawkish monetary policy and talk from the Federal Reserve. So remember I said they've got to have some data to stand on. Strong jobs picture tells them, look, we're not shutting this economy down. Economy is resilient. People are getting, work. Do you understand what I'm saying? So that's to me the chess match, if you will. Okay. Very cool. And yeah, as far as smart money goes, my friend, I don't know who that is. I don't consider myself, but there's big money out there. But to your point, what's the interpretation, right? So I love chess, by the way. So I love the question. All right. AA learned a lot with, very cool. And my calm nature, AA, I'll tell you what, if I let the pendulum of emotion swing, I'll listen to traders out there on YouTube or wherever else, and they're emotional and they're swearing and things like that. And it's not, number one, who wants to listen to that? Someone go, oh, beep, oh, beep. I see it on YouTube. I'm thinking, could you look any more an amateur when you cannot keep your emotions in check? Right? I feel bad for them. I was not always this way, but the more that I can automate and understand what my process is and simply follow it, it just is. It's never personal. It just is. It's just points. It's just dots and dashes and blocks and colors. And I just play what I see. And in that way, I'm either right or I'm wrong. And I just move on and find the next trade. So it takes some time to get here. But I hope that with automating tools and having a process, you all are able to get here quicker. And again, if you're getting emotional, and that includes celebrating your wins, remember that pendulum's going to swing the other way, and you'll be equally disappointed and depressed and everything else when you lose. So you just kind of stay in the middle, right? Stay in the middle. So I appreciate that. It took a while, right? It took a little while, but As my father-in-law says, which I love this, if you're going to be dumb, you better be tough. So I try my best not to be so dumb. All right, gang. I'll see you at the top of the hour for charts and coffee. Thanks for coming in for this little experiment as we traded non-farm payroll live, so you could see the levels I was looking at and the rationale behind it. You can check the playback. If you have any questions, leave them below. And you know what? I do want to mention, if this was pretty cool, you're thinking, hey, Rog, that was kind of neat. How do I do this myself? On the 16th of this month, just 13 days away, we're going to have a more in-depth discussion about these HPMRs, about time, about volatility, and about the way that I day trade. So pencil that in. 16th, that's a Thursday, 8 p.m. Eastern, prime time. We're gonna have a great conversation about setups like this. And by the way, yeah, I'm gonna keep this trade open as long as I still have some decent bearishness and I still see some lower lows and lower highs. Look at the structure getting red again. So I'll just surf this wave as it takes me to shore. Be good to each other, gang, and I'll see you at Charts and Coffee.